Monochrono Bitcoin ETF provides investors with a regulated pathway into the cryptocurrency market.
When you're ready to take your investments to the next level, you might want to consider Monochrono.
Hello and welcome to the Global View on this Monday. I'm Andrew Gagan. Great to have you with us here to start the week at ausbiz. Well, let's take a look at what happened on Friday. Equity markets finishing deeply in the red on concerns of weak economic growth, with MSCI's gauge of global stocks falling some 2%. Bond yields and the US dollar also fell sharply following US jobs data, which was much softer than expected. So on Wall Street, the rotation out of tech stocks gathered pace as investors sought safe haven assets. The SIBO Volatility Index, the VIX, hit its highest level since March in 2023. The S&P 500 closing at its lowest level in 2 months after it and the Dow suffered their biggest two-day slide since March last year. The small cap Russell 2000 also slumping. Chip stocks continued their recent downdraft led by Nvidia. And among the positives though, Apple shares did rise slightly after posting better than expected third quarter iPhone sales and forecasting more gains. ExxonMobil posted a better than expected $9.2 billion second quarter profit based on rising oil prices and volume gains from its purchase this year of shale oil firm Pioneer Natural Resources. And Chevron saw sharply weaker second quarter earnings, while it has discounted the chance to close a $53 billion acquisition of Hess Corp before the middle of next year. Well, the US unemployment rate jumped to an almost three-year high of 4.3% in July as hiring weakened, marking the fourth straight monthly increase in the jobless rate. Non-farm payrolls increasing by 114,000 jobs last month. That's well below the 200,000 needed to keep up with population growth. And the increase in annual wages last month was the smallest in more than 3 years. Well, the data has prompted institutions such as the Bank of America and Goldman Sachs to now forecast 3 US rate cuts this year instead of 2, while Goldman economists have raised the probability of a US recession in the next year to 25%. Well, US Treasury yields slid after the jobs data, the 10-year dropping as low as 3.79%, while the 2-year fell below 4% for the first time since May last year. And the US dollar dropped to a 4-month low, as expectations grow that the Fed will cut interest rates by 50 basis points in September to support a weakening economy. The Aussie is trading at 65 US cents. Well, let's get across all that data and what it means, particularly for earnings. Chad Padowitz is joining us from Talaria Capital. Chad, a very good Monday morning to you. Thanks for joining us. So, clearly the focus now, not so much on those rate cuts, which had buoyed investor optimism. Now the reverse is the case. There's concern those cuts will mean obviously a weakening economy. What data are you looking at the moment that maybe is of concern?
Yeah, look, I think ultimately the biggest data that matters is employment, because employment drives wages and wages drives revenue and profitability for the corporate sector and the equity market. And as you mentioned, the unemployment rate or the jobs numbers been pretty weak. The leading economic indicators in terms of job expectations has been very weak for some time. And actually the August ISM survey on the employment side was actually one of the weakest in many years. So there's certainly a lot of weakness in jobs numbers, in employment. The SARM rule, which is a very big recession indicator, actually got breached on Friday. And all of that means that the market narrative, in our view, has changed from, we've tackled inflation, now the economy is going to be fine, we've got lower rates coming, to one of the dropping rates in order to protect the economy from a more severe downturn, which obviously the equity market doesn't like. Yeah,
that narrative has very much turned now to bad news being bad news until you
Yes.
follow the market. What are you looking at perhaps historically there, Chad, that maybe gives you cause for concern given where we're at in the rate cycle?
Yeah. So of the past 6 interest rate rising cycles, once you've had a pause, you usually have a high level of earnings expectations following that pause out to 2 years on average, generally over 2 years. So the market tends to be quite optimistic when you pause interest rates. However, of those 6, 5 of them have actually turned out quite poorly, quite significantly so, i.e. the expectations were not met, and it turned out to be a pretty poor outcome. Now, we think we're one of those 5 at the moment where it's likely to happen as well. The one exception was 1995, but that was in an environment where unemployment was 8.3% and falling, the yield curve hadn't inverted, and the leading economic indicators hadn't been negative. So we don't think those actually apply. So in that environment, in the environment we're in now, which is interest rate pause going to a drop eventually, is actually quite negative for earnings and quite negative for equity markets.
How do you prepare for that then, Chad, if the expectations are that earnings are going to be hit as we go forward?
Yeah, well, as an investor, the best way to prepare is to stay out of the path of destruction or problems. We see the challenges are twofold in the equity market. One is on the valuations ascribed to most sectors of the market, but in particular the concentrated growth sectors. So there's a high level of expectations and valuations there, which we think is challenging. And on the other hand, we think there's quite a significant risk on the cyclical side. So industrials, energy, financials, because if the economy is getting weaker, they will be impacted. So the way to thread that needle, so to speak, we think is in more defensive sectors like healthcare, like utilities, like your consumer staples.
All right, we'll get into some of those opportunities in just a moment. But Chad, are you seeing these issues you just mentioned largely contained in the US, or is this likely to be a global story, do you think?
We think the global economy has been weakening. China, we know for quite some time, has been quite weak, and the consistent economic data from there has been weak. Europe, likewise. So this is a global thing, but the valuations are the most acute, and the optimism was the highest in the US. So we think the change in expectations and change in narrative is most particularly impactful on the US, but purely on the economic side, I think it is a global issue.
All right, so Chad, then let's get into one stock in particular. You mentioned healthcare is not a bad place to be at the moment. Your stock in focus is Medtronic, which certainly services particularly Parkinson's, diabetes, and the like. Why are you liking this stock?
So a company like Medtronic is a global leader in many sectors of medical devices in the healthcare space. They do about 30 billion revenue, 100 billion market cap company. So mid cap, but reasonably large. They have a 7% earnings yield, a 3.5% dividend yield. So the valuation's quite attractive. They pay out half of that in a dividend. The sort of services they provide are a lot more defensive. And healthcare as a sector generally tends to be one of the best performing sectors once you start getting interest rate cuts. So as a sector, we like it. As an individual company, from a valuation and positioning in the sector, we like it.
So that's the case for Medtronic. Any others? Well, you said you like healthcare. Any others that are on your list at the moment?
Yeah, we like French pharmaceutical company Sanofi. They're a pharmaceutical company, trades on about 10, 11 times earnings. So around 9% free cash flow yield, 4-ish% dividend yield. They have a lot of R&D that you're not effectively paying for in the share price. Pharmaceuticals obviously are very different to the economic cycle and interest rate cycle. So that's an example of a share that tends to be underappreciated, but economically should do far better in this environment than other companies more exposed to the economy.
Chad, terrific to get your outlook there from Talaria Capital. Thanks so much for joining us on this Monday.
No, you're welcome. Thank you.
So, okay, that's what we're seeing more globally. Let's then focus, just before we go, on what's likely to happen on the local market. As you can see, SPI futures there off almost 1.5%. So that steep selling we saw on Friday likely to continue when we get going in just a couple of minutes' time, reflecting also, of course, what we're seeing on global markets we've just been talking about, where investors now are very much focused on, well, essentially the fear now that rate cuts indicate that the economy is weakening, and that is going to impact earnings going forward. So stay with us. The Open is just a couple of minutes away.